Support and resistance versus pattern structure. Simply put, support is just an area where price is likely to reverse from, since based on previous historical data, it has a tendency to bounce from that level. So let's just assume that price is dropping to the downside and it bounces off, right? Okay, that's the first significant level. Once price drops again to the previous support, what's very likely to happen is that price is likely to bounce off from support. Now that price has bounced from support, where is it likely to go to next? It's likely to go to previous resistance. And you can consider this a typical range. Now, it doesn't mean it's going to be there forever. What could also happen is that once the price continues to drop and it fails to bounce from the level, it could do a break and a retest to a previous support level. Where is it likely to go to next? To the next support. It's as simple as that. We can just call it structure, right? If you look left, structure leaves clues. If you look left, structure leaves clues. There's a break and retest. Price is likely to retest the previous structure, right? Now that price is rallying to the upside, if you include your support and resistance or your structure levels, what can we see? We can clearly see that price now is likely to retest this particular level. Not this level, this particular level, because it's the most relevant, right? So two things can happen. It could either drop to the downside or it could do a break and a retest. Let's just say it does a retest to, again, previous level. If you look left, rallies to the upside. Two things can happen. It can drop or it can rally. Let's say it drops. Okay. Price then drops, it decides to just completely smash through all levels. And where is it likely to go to next? It's very unlikely that price will continue going up towards this level because it needs to retest. The only reason price can actually retest this level, it really depends on what confluences you have, what the bigger time frame is telling you, and other schematics and strategies indicating that price could potentially continue rallying to the upside without a retest. But right now, we keep to the basics and we just trade what we see. So what do we see? A potential retest to where? You look left, structure leaves clues, and then price obviously can rally to the upside, most likely towards this new level of resistance, a break and retest, and a continuation to the upside. So this is just a typical example of support and resistance and how you can trade it. So again, we've got support and resistance, typical stuff. Where is price likely to reverse from? What do we see? We can obviously see this. Okay, we've sold the market and we sell the market towards this level. Okay, fair enough. The price dropped to the downside, but we need to be conservative. In this occasion here, we sold the market and this is our potential area. Again, if we're to buy the market, where are we buying the market to? If you look left, structure leaves clues. The reason we're buying it is because price is dropping down to the previous level of structure towards the next level of resistance. Obviously, your stop loss will be just a little bit below, and this is your TP. So this is just a typical way of trading retail support and resistance. It's very effective, but the only issue is that you're really limiting yourself to potential gains. So if we're to sell this particular market, where are our targets going to be? It's likely going to be towards the previous level of resistance, previous structure. As you can see, it's likely to do two things: a drop from it and then a rally back up it, or a break and retest and a continuation to the downside. But to be conservative and not be too optimistic, this is a very typical area of an exit. However, if we utilize pattern structure instead of support and resistance, we can actually implement a much bigger exponential risk reward. So what do I mean by that? If we're to add a channel, parallel channel, just a simple pattern structure, look at the difference. We're now utilizing the top end of the channel as a dynamic resistance and the bottom end of the channel as the dynamic support. The same applies with your typical retail support and resistance. We're now applying it to patterns. So look, we've got a pattern here forming. We've got 1, 2, and a potential third tap. We've got 1 and obviously 2. And now all of a sudden, not only are you extremely increasing the gains, you know, if this was to go there, let's actually move it here. Look at the difference in risk reward. Not only are you increasing the risk reward, but also eliminating all the noise in the middle, all the ifs and so's and hopes, and all the moving averages, all the indicators telling you that price is going to completely explode. The moving averages saying it's now bullish, or the MACD saying it's bullish. So you're looking to come out here or at this level, but the channel really is just telling us there's one big move happening. So this is the effectiveness of trading support and resistance, but using patterns as your structure and relevant levels for your entry. Let's follow the market now. Instead of trading support and resistance where there's plenty of noise, we've sold the market to the downside towards minimum this level. And price can do many things. It can bounce from this level. Again, psychology is going to tell you, oh, it's bounced from here before, there's a likelihood it's going to bounce up. So you might be taking profits early, then it drops and you're definitely taking profit at the next support. And then you find out it does actually pull back, but all of a sudden it continues to drop. There's a break and retest of the levels, and it just keeps on dropping and dropping and dropping and dropping and dropping. And then all of a sudden you realize, oh, hold on a minute, I could have held a trade all the way down, as you can see, towards this level. Right, so now you've completed the bottom end of the parallel channel, and now you're looking to buy the market on the way up. And where are you likely to pull, buy the market on the way up? Again, same principle. We can now buy the market all the way up towards the top end of the particular channel. And again, if we buy the market, you're eliminating all the noise in the middle, and you're all of a sudden improving the gains towards the upside. So this could be a good area to take profit on this particular simple channel trading. So really, truly, we don't need all this support and resistance. So if we were to just completely freestyle how a pattern can be forming, what can we see? We can actually see there's a particular pattern here forming. So you're eliminating all the noise towards the downside and the upside, and you can be entering the market here. Notice how not only are you entering the market here and improving your gains, look at the market psychology. What do you expect retail right now would do once prices dropping, etc., and then it breaks a very significant level of support? Look at the significance, right? So you're expecting price to now drop to the downside, break and retest. So right now, sell traders are selling this market. Now that sell traders are selling this market, they're selling it towards this area, right? This is what retail is looking at. And then all of a sudden, you then see you getting triggered in. Once you're involved now, imagine all the traders now buying the market on the break and retest. So now they get triggered in, and then boom, you've got all this potential profits towards the upside, and your target would be up here. 1, 2, and then 3. The reason this is the third area is obviously because, yes, there is structure here. So price is likely to reverse towards the downside. And this is why sometimes you see, and you ask yourself, why didn't price reach my area of resistance, which is up here? Only to know that this particular pattern already just played out, and you missed out on a sell limit, or retail traders are expecting price to break and retest this level, or a rejection and then a drop, but it didn't even reach there, and it reached the top end of the pattern. So this is the advantage and the edge of trading pattern structure instead of support and resistance structure. The same applies to price action patterns. So again, this is your typical retail head and shoulder, right? And what does Google and all these courses tell you? That once the neckline is broken, what do? You obviously sell the market and the break and retest, and you can put your stop loss above the actual neckline, or potentially, to be conservative, above the actual right shoulder. And your take profit would be the equivalent of this particular move down, right? And the break of the neckline. So really, this is where your TP should be. So there's actually there's a little bit further. So this is your typical head and shoulder. Typical head and shoulders entry on a retail setup. So you've sold the market, and have you realized that it doesn't always play out like you've been taught in a textbook, right? Again, yes, it does sometimes play out, but when you're utilizing pattern structure instead of your typical support and resistance, because again, you've got your head and shoulder, you've identified that you add the length of the head to the neckline towards the breakout, just how you've been taught. This is your target. You're very confident. It's made a new low. It's even making new lower lows and lower highs. You can see lower highs, lower low, lower low. You're expecting this to be a new low to take this out and complete your setup, right? Now, again, this is very, very basic, but what happens is because you're focusing on just the retail metaphor, the retail setup of a head and shoulder, you've even got your support and resistance. You know, I've included the range and the length of the head and the neckline towards the breakout. This is your typical head and shoulder setup, right? Now, the only issue is that since many traders and 90% of traders are seeing the same thing, again, we've got previous structure, all the confluences in the world, a break and retest towards the neckline, right? We're making lower highs, we're making lower lows. We're expecting this new lower high to make a new low towards at least the length of the previous breakout, the previous head and the neckline towards this particular move here. So this is your desired take profit. And obviously you're monitoring this particular area to maybe take profit early, etc. if you want to be conservative. But let's see what happens on this particular setup. So what could happen is, instead of utilizing what everyone else is seeing, if we in fact implement simple price action structure, what can happen is this, right? So we're seeing retail seeing a head and shoulder. But if you don't update your patterns, you don't see what's actually happening right in front of you, what you'll see is that price could easily just do this, can drop towards the downside, breaks even the support. So you hold your trade, and then all of a sudden what's happened is completed a 1, 2, third tap of a new bullish wedge, and it completely rallies to the upside. And then you say to yourself, what is wrong with the head and shoulders? I need to start back testing, etc. And you ask yourself, why is it wrong? But look at the psychology. It breaks support, entices traders to hold the shorts, right? It then pulls back, and then you're thinking, okay, it's pulling back, and this is where you're expecting price to drop, and it just continues to go up. And then once it goes up, you've probably moved your trade emotionally to break even, and then you get taken out break even, and it just keeps on going up. So not only are you in the wrong side of the trade, but you're trading the way every other trader is always also trading.